Welcome back to Behind the Win, the podcast where we go beyond the deal to talk grit, leadership, and the real stories behind big decisions. Today, we're joined by Matt Maltese, mortgage advisor, team leader, and one of the most grounded voices in an often chaotic housing market. Matt has built a reputation not just for his lending expertise, but for the way he leads with empathy, steadiness, and service. In this episode, we talk about navigating volatility, managing client emotions in an election year, and building long-term relationships in a short-term world. Whether you're in real estate, consulting, or just trying to make sense of the headlines, Matt's insights are a reminder that clarity, calm, and a little humor still go a long way.
At LSI, we don't just follow trends. We help shape the future. Welcome to Behind the Win, the podcast where we break down the biggest moves in tech, innovation, leadership, and government contracting. Here at LSI, we're bringing you exclusive conversations with the minds behind groundbreaking advancements, disruptive strategies, and industry-defining wins. From retail to tech, defense to government solutions. This is where you get the insights to stay ahead. Let's go behind the win.
Okay. Matt, you've been in this industry through some wild economic swings. Does this current market feel more chaotic or just differently chaotic?
Yeah, there's always a challenge. There's always turbulence, and it's like in what form. But the housing market right now it's like stuck in the mud. There's the fewest number of transactions that there's been in decades, which, obviously as the population grows, that should never happen. But we've got the least number of transactions in like 30 years. So the housing market isn't not a good or a bad or crazy, it's just stuck. There's just not nearly the number of transactions that there ordinarily would be.
What are you contributing that to?
So that is basically these COVID interest rates of 2% and 3%, where you have these where ordinarily life would happen and they would move on from their home. They can't justify financially moving on from their home. Example, let's say the kids are off to college and they've got this big house and they want to downsize. Well, they wouldn't even save any money by downsizing because the rates today are 7 and the rate that they have is 3. Or you take a family that has a couple of kids, they had a few more kids, and it's like, we need a bigger house. And it's like, all right, well, we're not gonna get a bigger house with a rate of 7%. We're just gonna add on or suck it up. So what you have right now is not so much discretionary movers, but like gun to their head movers. Like, I have to move.
Right, for work or something.
Yeah. Or I have triplets. Like, I have to get out of this 1-bedroom condo. So, so discretionary buying is just on the sidelines while all you have is essentially this mandatory buying.
Okay, so COVID rates were crazy, right? I remember I bought my house in 2020. My interest rate's 2.1%, which is insane.
Oh, yeah.
But I remember my first house and I shouldn't even say the year, but 2000 was, I think I was at an 8% interest rate right back then. So where do you think, in your opinion, these rates should be at that things would start moving again?
So without a pandemic, that kills millions of people. So aside from that, your range of interest rates should be in the 5 to 8% range. During the financial crisis, they were artificially sort of in the 4s, and I say artificially, I'll get to that in a minute. Same goes with COVID, 2s and 3s. And so I'm going to drag you down a rabbit hole of how mortgage rates move.
Let's go.
The question. So everyone here is like, oh, the Fed lowered the rate, and most people assume that mortgage rates instantaneously dropped by whatever the Fed lowered the rate to, and that's not at all how mortgage rates move. Mortgage rates move based on certain bonds in the bond market. It's called these mortgage-backed securities. So it was set up by Fannie Mae and Freddie Mac. They were set up in the 1930s after the banks had gone bankrupt during the Great Depression. And ultimately, Fannie and Freddie are there to purchase all the bank's mortgages, package them into mortgage-backed securities, and sell them to institutions and investors all over the country, all over the world.
Okay.
This allows the bank to go out and make more loans the next month. So the mortgage companies essentially have this mega line of credit. They lend out $100 million in mortgages. They sell the mortgages to Fannie Freddie, and then they pay off their line of credit and they go and lend again. So the the mortgage rates are dependent on the buying and selling of these mortgage-backed securities. So the more investors that are buying mortgage-backed securities, the lower the interest rates. And if investors turn around and start selling these mortgage-backed securities, rates go up. The rates that people are paying is the rate of return for these investors. So if there's this massive amount of demand for a mortgage-backed security, the rate of return or our borrower's interest rate is going to drop because there's a long line of people wanting to buy this mortgage-backed security, and so the yield is going to drop. And the opposite happens when there's a sell-off in these mortgage-backed securities. The mortgage rate and the yield to the investor, same thing, has to go up to entice people to get back in line to buy the mortgage-backed security.
So this is standard supply and demand, not so much when the Fed drops, it drops.
Exactly. Now, what the Fed did during COVID and during the Great Recession was they stepped in line and they started buying mortgage-backed securities. And that's what essentially drove mortgage rates down. That's also called quantitative easing. And they did that from around, I don't know, call it '08 to actually through COVID. They were still doing it in 16 and 17. And that's why mortgage rates had stayed so low they were in the 4s and 5s for I don't know, a decade, 12, 15 years. And COVID hit. And before COVID hit, they were still in the 3s and 4s. They were still in the upper 3s, low 4s, because the government was still participating in quantitative easing and essentially buying mortgage-backed securities. And then when COVID hit, they doubled down on it and drove rates into the 2s and 3s, which was, in my opinion, a total overcorrection. The housing.
So where we're sitting today is more, you see it evening out more, maybe down a little bit, but where we are today rather than where we've been in the last decade or so at those low interest rates.
Yeah. So fast forward, they realize inflation's a thing, and they not only stop buying mortgage-backed securities at a time where, inflation is going to cause a sell-off in the bond market, because at the end of the day, let's say I've got $1,000 and inflation is now running at 6%, and I'm sitting in this bond that's paying me 4%. Well, I'm basically losing 2% of my money, right? So there's going to be a sell-off in bonds in the face of inflation, which means rates are going to go up. And then there's this equilibrium point where investors are like, all right, cool, I'll get back into bonds. That rate of return is acceptable to me based on where inflation is. So as inflation started to become apparent, the Fed stopped buying mortgage-backed securities. So you already had this selling pressure on mortgage-backed securities. And then the Fed stopped being this sort of permanent buyer of mortgage-backed securities and essentially just let it rip. And so what's interesting is that mortgage rates had never gone up that fast in the history of mortgage rates, even during the 70s and 80s, where mortgage rates were, 15%, 16%, et cetera. Even during those times, the most rates had gone up in a year was like 2%. But once the Fed stopped buying mortgage-backed securities and inflation sort of triggered investors from buying mortgage-backed securities and started selling mortgage-backed securities, mortgage rates went up 4% in 1 year, which had never happened in the history of mortgage rates.
So talking a little bit before you talked about the Fed and people, what's the Fed going to do? When the Fed makes a move, do your clients panic text you? And what's your go-to
Yeah.
Maltese calming line when they start spiraling?
Yeah, so I recently started making these videos, and it's become a library of things that I have to talk about all the time to clients. And so, I'll certainly tell them, like, and I go through the explanation on how mortgage rates move, um, and that the Fed didn't magically raise or lower their rate. And then I just send them the video because probably a 2-minute explanation. And they might not grasp it right away, but after watching the video, hopefully, it makes more sense to them. But yeah, I mean, it's as soon as the Fed does something, I get this barrage of phone calls about what they think mortgage rates just did. And actually, you can see mortgage rates go up based on if the Fed lowered the rate. It's really all about market expectation and then what the Fed said after they did what they did. So if the market expects a 0.25% drop and then expects the Fed to hint at possible other 0.25% drops, but they drop it a quarter, but then they don't say what the market expected them to say, you could see mortgage rates actually go up when the Fed lowers the rate. And that's actually what happened. I think the last time the Fed lowered the rates, I want to say it was in the fall,
Yep.
October, right? But everyone expected that. So what you saw was mortgage rates were dropping in September. And then when the Fed actually lowered the rates, mortgage rates went up because they didn't really, what they said and their rhetoric didn't match what the market expected them. So,
And that's interesting because I think I was not educated. I know I wasn't educated. I remember watching something on TikTok that said, because the Fed rate moves doesn't mean that it's going to move the 30-year fixed mortgage. And so I think that that's funny because people would automatically, and I heard someone say, oh, if that's the case, I'm going to refi. And it did nothing to the
right,
mortgage rate.
right. Well, and then a common like customer comment will be, yeah, the banks, they're hoarding the profits, and it's like, there's like thousands of mortgage companies. As many gas stations as there are mortgage companies. So
Right.
if you don't like the price of the gas station on the southwest corner, you could just go to the northeast corner and get the cheaper gas. So it's mortgage companies can't just hoard the savings of Fed lowering the rates and not pass it on to the customer. First of all, it doesn't work like that. But second of all, even if it did work like that, you'd have 10,000 other mortgage companies that would be happy to pass on the savings to the customer. So they had
How do you talk clients through, the uncertainty, especially when the headlines, like you mentioned, are scary or rhetoric?
Yeah, for
You know,
me, it's all education and data driven. I don't sell anything. I don't try and persuade them to think a certain way. These are the facts. This is the data. Where it's going, no one knows. But it starts with like, okay, let's get a baseline of facts. As an example, inventory, right? It's like, okay, yes, inventory is up 40%. It's also 3 months supply, um, so it's just, there's a lot I can drag from the internet and then show the customer, hey, here's what's really going on. There's a great website that's, first of all, the 10-year US Treasury is a great instrument that anyone can follow. You can Google it, it shows up. You basically add 2.5% to the 10-year US Treasury, and that is about where the average 30-year fixed is.
interesting.
That's a great way to real time know what's happening because whatever you read, let's say something comes out today, rates are up or rates are down. 12 hours later, it could be completely opposite because it's like a stock in the stock market, mortgage-backed securities, and it's in the bond market, so it's traded throughout the day, and it can change in the blink in a matter of an hour.
When there is offers, right, that they want the interest rate bought down or the point, on that? How educate our listeners, what does that mean and what is it doing?
Think of rates as a menu, right? And so your rates range anywhere from, call it 4.5% to 8.5%. And they're offered in increments of eighths. So 4.125, 4.25, et cetera, et cetera, et cetera. Each rate has a cost next to it. And it's the cost that actually changes on a daily basis or an hour or sometimes throughout the day. So it's not the rate that actually went up or down. It's the cost of each rate that's changing every day. So in terms of a rate buy down, let's say you'll hear the word par or 0 points, and someone goes, I don't want to pay any points. Everyone's different. It just depends in people's scenarios. But to buy it down is to say, okay, like the rate with no points is this, say 7.25, and I want to spend 1 point, which is 1% of the loan amount, and get a lower interest rate. So it's like, okay, you look at the rate sheet and you determine, which rate costs 1% of the loan amount in fee, and that's buying down the rate. But It's interesting. I had a client where they'll be in a much better financial situation in about 6 months, right? So they have to get this sort of like alternative loan with a higher interest rate. And their immediate brain is going towards, yes, I know it's going to be higher, but I still want the lowest rate in this higher sort of loan program, right? I was like, no, you don't, because we're going to refinance you in less than a year.
Right. So you dropped all this money up front,
right,
that you're going to be in a different situation in
right.
6
So
months.
we ended up, it's like $1 million loan. We ended up doing a lender credit of 12,000. Yes, it's a 0.5% higher rate. Yes, the payment's 500 more a month, but you're only going to make 6 payments. So you're going to get 12,000 to go towards your closing costs at the expense of, call it a $500 higher mortgage payment, where let's say you make 6 payments at most, you'll have paid 3,000 in total at this higher rate, but you have gotten 12,000 at closing. So you refinance out of it. The rate was 8%, and I would argue that that's probably the best package I've put together for a customer all year, and it's at the highest rate.
So really, when the buyer is saying, I want the seller in an offer to buy down that rate for me, they're basically just bringing more concessions to the table, or more amount of money, if you will.
Yeah, and you really, as a realtor negotiating, you're negotiating, I want X towards closing. Whatever the buyer decides to do with it, whether it's
is up to them.
They want to do a buy down, they want to buy down the rate, whatever. But yeah, they want to negotiate and get X towards closing and not specify where it's going to go, because if they decide, they talk to a lender and like, yeah, I don't want to buy down the rate now, but it's in the contract as buying down the rate, then you've got to, make the changes. Yeah.
Okay. So often we say here at LSI that the sale's just the beginning. In your line of work in mortgage lending, how do you turn that transaction into a long-term relationship?
So for me, it's taking a complicated product and communicating it and educating the customer so that they're making their own decisions. And at the end of the day, they close and they're happy because they know what they chose and why they chose it.
So it's doing that, because people aren't buying houses, most of them, every year, right? So You're going to get 1 or 2 in a lifetime from that person, repetitive business. But is it that they're telling other people to use you, the referrals, et cetera, too, that come along with that?
Yeah, for sure. And some become real estate investors, and you might end up doing like 10 transactions, over the lifetime. And now I'm starting to get their kids, which is freaking crazy.
Means we're old, but that is cool.
Yeah.
Well, and I think back to, again, closing on one of my first houses, 25 years ago, I remember people giving horror stories saying, oh my God, you're going to be at closing for half the day. right? That's what it was back then,
Yeah.
is that it was so long. And I remember they didn't have everything right. Now, when I walk into a closing with a client and it's because of, right, the mortgage lender and my title, like you guys are great, that they walk in and it's like 5 minutes. Because they've already been communicated what everything is. They check over that first sheet and it's good to
Yeah.
go. So
And
it's the
that
same.
is definitely a good byproduct of a lot of the regulations that rolled out after after the mortgage meltdown.
Yep.
It was the wild, wild west. You could have told your customer, this is what you're getting. And at closing, you could have hit them with whatever, you wanted to. And there was nothing to protect the consumer. They either had to sign it and close or cancel and start over. So nowadays, the lenders couldn't, once they disclose a list of fees, that's it. They can't change.
Right.
And unless circumstances change, like their credit score dropped or whatever. But generally speaking, even then, you've got to redisclose. There's got to be a waiting period where they have time to look at it, sign it, think about it, and then they go to close. A lot of times now they're like, well, we want to get this wrapped up. Can't we just skip this waiting period process? And it's like, nope. Sorry,
Nope.
you gotta see these
Yeah.
forms, have time to look at it. And then by the time you get to closing, they're just signing away. They're not looking really at anything because they've already been shown the numbers, 10 times.
Along the way.
Right.
Right. Have you ever had a client situation that really challenged your people first approach, right? And how did you handle it? Like any crazy ones that come up in the last year or two?
Like where they were total jerks.
Yeah, I think that would be a challenge, or that you've communicated it to them and they're going to say you're not. Like, yeah, something around that, or what's
Yeah,
the
yeah.
biggest challenge?
Yeah, so I think uh occasionally you're going to get a customer that is getting different advice from a different loan officer, and ultimately they're going to just have to choose who they believe or not, because they could be told entirely different, um, or given totally different advice than what I might be giving them. So there was an example where a person had a lot of collections and they were trying to raise their credit score. And I'm a believer of, look, if you owe it, just pay it and move on. Negotiate it, maybe get a better deal on the collection balance. But like this whole mindset of disputing is just kicking the can down the road. So a lot of people will dispute something, and I'm all for disputing if it's not yours. If you didn't sign that paperwork, like, cool, dispute it. Like, eventually you're going to win because they won't have the paperwork to show that that's your debt, and your credit score will go up as a result. But if you owe it, then just pay it and move on. And it doesn't, when you pay a collection, it doesn't immediately improve your score, but long term it will. And you just sort of mop up mistakes of the past. You get to move on. So I had a client where they're trying to get their credit score up. I said, look, if you owe it, this is for you to decide. If you owe it, pay it. Yes, it's going to take a few months, but eventually it's going to go up. And another lender was advising them, no, dispute it. Your scores are going to jump up, and then we'll be able to get you qualified. And it's like, there's just in my mind so many, and they were like, yeah, we don't appreciate that. So the feedback from the customer to me was, we don't appreciate your advice that you gave us. We're going with another lender. You should have told us differently. And it's like, as the lender, I'm like, I should have told you to not pay your bills. Like, what world are
Right.
you living in? So I said, all right, good luck to you. But
But I
so,
think that's okay. Sometimes it's that, yeah, we're not a good fit, right?
right,
That's good. Go ahead
right,
and you go with your, whoever else you think. And I think they get a lot of that, right? Because I see that on the TikTok feed all the time, is that it's like, hey, you can, with this new administration, you can dispute all these credit cards it's illegal for them to report it. I mean, they get a lot of the bullshit rhetoric we've talked about.
right,
So, but I've had lenders that also with clients have said, yeah, let me get them to pay this off and then rapid rescore them. Right.
right. Yeah,
That's great too. But
right,
yeah, it's like, you don't want to, you're not a magician.
right. And I don't know how much in the weeds anyone is going to even care about this, but most of the underwriting is done by a computer. So there's these software systems
Yeah.
developed by Fannie Mae, Freddie Mac. It's called LP and DU. The computer says yes or no. The underwriter validates what you fed the automated underwriting system. So if you're disputing certain credit lines, it taints the automated decision, and often an underwriter says, take it out of dispute. But that doesn't happen until you're already under contract, and now you're really up a creek without a paddle because you already know the score is going to drop because that's what you did in the first place to try and drive it up. So a disputed trade line is a terrible way to go unless it's truly not yours. Then by all means.
Okay. Let's say you could send a message to every first time home buyer in the US right now on a billboard. What would it say?
All right, it's got to be a big billboard. So it would say, talk to a good lender, understand the math behind buying this home, because I think in a lot of markets, it is going to cost you more to own it. Like, let's say you got two homes in the neighborhood. This is a huge billboard. All right. You got two homes in the neighborhood. One's for sale, one's for rent. They're the exact same. I want to buy this one. I don't have a ton down, and I don't want to rent it. You're going to be paying a lot more to own the home. So you want to say, okay, well, why am I doing this then? Like, what are the reasons behind it? You want to understand those reasons so that you can get on board with, paying more per month. First, but you also want to make sure that you're comfortable with that payment. Obviously, you got to make sure that you qualify for that payment, but both have to be, both have to be in sync. If you qualify, but you're not comfortable with it, then you don't want to buy the house. You don't want to buy a house yet. If you're comfortable with it, but can't qualify, well, then, obviously that's a problem too. So you want to align what you're comfortable with and what you're qualified with and make sure you're good with both, as opposed to,
Wow, I can spend $1 million. Let's go
yeah,
spend it.
wow, I'm approved for a loan. Cool. So know
Do
what
you
you
think,
need to do, I guess it would be the billboard. If it was short, yeah, I don't know. Know before you buy, something like that. There you go.
yeah, okay, love it. Do you think our kids are ever going to be able to own a home someday? And
Yeah.
as early as we did, right?
Yeah. So I think we have to help them, because we helped, I say not like we did anything to the home prices, but we certainly benefited from it. So I
Absolutely.
feel like it's going to be up to us to help them afford that home. And that could look like, hey, your first year in your real job, you're going to live home, you're going to save up a ton of money. I'm going to match what you save, something like that. Also, though, and I'll speak locally, but I do think I think this could translate nationally. The government owns a lot of land in Nevada, and they're very slow to release it. And it's got to get pushed down to the local levels. So the local levels can get it in the hands of home builders at a reasonable price so home builders can build affordable housing. Somehow in this massive state of Nevada, where we've got two tiny little cities, we have a land shortage. Like, that makes zero sense. We don't have a land shortage. We have a housing shortage. That shouldn't be the case unless you lived in Manhattan or Hawaii, right? So it's ridiculous. So that's one thing where there's got to be a way to build affordable housing. Part of that way is cheap land. If the land is
Yep.
already 200,000 an acre, how are they going to build? How is a home builder going to build a house for anything less than 500,000?
And I love that you bring that up because one of the best things as a realtor is we get to go every January to the Economist mortgage kind of forecast, right? And I love it because they said that birth rates are on the decline. And what that means if people don't, because people are like, I don't care about affordable housing. I have my house. I could, I don't give a shit about someone who can't afford it. Well, you should, because when those
Right.
birth rates decline, and that affects the whole entire economy, right?
Right.
And growth. And that's what I think is awesome that you educate educate people on, along with things like the mortgage rates. Just because the Fed took it down doesn't mean the mortgage
Right.
rates moved at all too.
Yeah, you
So
should, for me, I can't predict. I can only explain what happened, and why, and then give insight as to, possibilities of what could happen. But yeah, it's interesting to me. I majored in economics, and it's like, why'd you major in economics? I'm like, I don't know. I went to my counselor, and I had to pick a major. And I go, well, what do I have the most credits in? Like, economics. But
what's
I
the
regret.
easiest path to graduation?
Yeah,
That's what I'll
exactly.
take. Okay, what are you most proud of in the way that you've built your entire business?
There's a scoreboard and how many families you help or how much loan volume you do. And I'd be lying if I said I don't look at that. But I think that scoreboard is just a byproduct of doing a really good job for your customers. So I don't, I forgive myself for looking at that scoreboard and at times being obsessed with it and wanting, to close the most number of loans, because that really means, well, if I'm
Sure.
closing the most number of loans, I'm doing a good job. I would say to that, I think the thing I'm most proud of is I've always advised on what was best for the customer. I often turn down a lot of business because I'm not the best place for them, like a line of credit, for example. I'll always say, hey, go to your credit union first. We have these fees. If they can't help you, I'm happy to help you, but go there. I could easily say, sure, I'll help you with a line of credit. Here's our fees, and like not mention anything. But I know credit unions don't have fees when they're doing line of credit. So why would I do that? Let them, advise them on where, give them the best advice, regardless of what it means for you for, getting a deal or not, or getting a commission or not. And at the end of the day, that'll all come back to you. That customer might refer me, all his family, because I gave him good advice as opposed to just trying to, close that one transaction.
I love that. I think that's putting right people first or customer first. So, and we have something similar, right? We do lots of state contracts, and in part of those, we have these ones called Apex accelerators that the state pays us to run and get and help small businesses do business with the federal government. And when they come to us, we could easily say, yeah, sure, sign up and it's, with us and we'll help you and it's X amount. But we always push them to the free resources first, right? Because sometimes they need that help. But then yesterday, and I love that you brought this up, is I was at a conference, had a speaking engagement, and I had one come up and say, hey, I think I've graduated that kind of program and want to come work with you guys. And that was a while ago, but they remembered that we said, hey, you can get this for free over here. Why don't you go dabble over there first?
Yeah, I mean, they're going to figure it out at some point. It might as well be you that educates them, and the more transparency you can provide, the more they're going to trust you. And at the end of the day,
Okay, final question, and there is a right or wrong answer, is who's the best baseball team in the world?
oh, I want to say the Yankees, but we got to be real. It's got to be the Dodgers. I mean,
You were
I
right the first time.
I
Not
mean,
in the last year,
if
just in general forever.
oh yeah, of course. Then of course. I mean, you can't
Yeah,
argue with the stats don't lie. The number of championships the Yankees have dwarfs everyone else. So
I
absolutely.
love it.
And the
So,
Mets,
Matt, it's been a pleasure having you on, your perspective on leadership, empathy, and staying steady through this uncertainty is something I think a lot of our listeners, especially those in the economic development area or business consulting, can relate to. So where can people find you if they want to learn more or connect with you?
yeah, I mean, my cell is always the easiest, 702-372-2427, or just go to my website, Maltese MG, the MG is for mortgagegroup.com. So maltesemg.com, and you'll find all of my contact information.